Now, joining me in the studio to look more into the, give us more insight on this budget is Damilola Akinbami. She's an economist with financial derivatives. Great to have you with me once again in the studio, Damilola. But let's take a look at this budget. I mean, at first glance, what are your thoughts? It looks good. We're seeing recurrent expenditure down 68.7% as opposed to 71.5% in the 2012 budget. What is your take?
Like you said, it looks good. It's clear the president is pushing for more fiscal discipline by reducing recurrent expenditure and also increasing the capital expenditure ratio to like 31%. And the president has stated that he intends to reduce the fiscal deficit to 2.17. So it's clear the theme is fiscal consolidation. The benchmark has been increased to 75. That's $3 above the 2012 benchmark, but it's still cautiously okay. At least with the savings current oil price at 114, so it's relatively okay. In the whole, it's a good budget, consistent with the framework, so it's good.
And so we're seeing an inflation in terms of the benchmark oil price. I mean, it was $72 per barrel. The president is announcing 75. The National Assembly wants $80
yes.
per barrel.
Yes, there's that controversy now between the president and the legislators over the oil price benchmark. Increasing the benchmark to 75 actually reduces fiscal savings, and that's where the issue is, because at a time like this where oil price volatility is high, we should be saving more and stocking up on our reserves. But by increasing the benchmark, there's liquidity. There's going to be a liquidity issue because it has inflationary impact, and if there's more money, more fiscal spending, prices could go up. And if there's inflationary pressure, we could see interest rates going up and affecting exchange rate and all that. So the increase in benchmark is an issue to consider, but 75, I would still say, is relatively okay. It's better than the $80 per barrel that the legislators are asking for.
Now, we're also seeing a projection for oil output of 2.53 million barrels per day in 2013. Certainly a lower projection than this. We saw a lower projection than this in 2012. Actually, in 2012, it was 2.48 million barrels per day. And realistically, right now, as of half one, production averaged 2.34 million barrels per day. So how realistic, I mean, do you think this projection for oil output is? Some analysts say too optimistic. Last time you were here, you said way too ambitious.
Yes, I still stand with my initial opinion that it's way too ambitious, because right now, on the average, we're doing 2.2 million barrels per day monthly, and the 2012 budget is saying 2.4, 2013 2.53. If we have not met the 2012 budget, how are we going to meet the 2.53 budget? So it's overly optimistic. There are the risk of production disruptions, the resurgence of manned activities, pipeline vandalism, and all that. And if we can't meet our production estimates, if there's an oil price decline, then our revenue estimates will come under shock, and fiscal deficit could widen further than the 2.17 that the president is projecting. So the production level is really, really optimistic, I must say.
Well, we're also joined, actually, Damilola, by Razia Khan. She's the head of regional research at Standard Chartered. Razia, Damilola here feels like that projection for oil output too optimistic, 2.53 million barrels per day in 2013. What's your take?
I think that's going to be the concern of many analysts. And the problem isn't so much what has the average in Nigeria been, so much as the lack of transparency in terms of being able to distinguish between the different estimates out there. Now, very recently, we had, of course, heard estimates that Nigeria has been producing near all-time highs. Even numbers as high as 2.7 million barrels per day have been bandied about. The difficulty is, first of all, we know the sector has not seen a great deal of new investment, that the regulatory uncertainty pending the passage of the Petroleum Industry Bill has held back investment. It would be very surprising if that were not having a more meaningful impact on output. The second part of it is, of course, the widespread belief that there is a certain amount of oil, no one is quite sure how much, that is lost to illegal oil bunkering. So will the revenue necessarily keep up with production estimated by who? How do you even trust these numbers? And then, of course, the third aspect of it, given that lack of transparency around how much is actually being produced, but there's also the wisdom. If you're not going to be increasing the oil price assumption that much, and we hope that the final outcome is still closer to $75 a barrel for the benchmark rather than the $80 a barrel that members of the House had suggested, but if that's the case, it isn't hugely comforting to know that the output assumptions are going to be relatively inflated. That has been a problem with the Nigerian budget all along. Now, it has to be said, on the face of it, a 5% increase in spending on the basis of what's been proposed, that is not bad. In real terms, that shows a certain amount of fiscal consolidation. But we do need to look closely at the assumptions underscoring that.
And Razia, I must add, the president also came out saying we're going to see GDP growth in 2013 being revised down from 6.8% to 6.5%. What are your thoughts on this?
Now, that's interesting, of course, because if we look at Nigeria's GDP statistics, there has been this gradual decline in the performance of the non-oil economy. The latest numbers that we had for the second quarter suggesting non-oil GDP was 7.5%, but there's an undeniable trend there. Given that Nigeria, very rightly in our view, is going for fiscal consolidation, I guess the expectation is do not expect a big boost to come from increased spending. That, at best, is always a very short-term thing. The more encouraging aspect is the quality of that spending, the share of capital expenditure rising, the share of recurrent expenditure falling, and the hope that key reforms in agriculture, in the power sector, are going to be able to unlock longer-term growth potential. Of course, looking at the very near term, because Nigeria is experiencing a relatively subdued increase in spending, the 5% increase in spending, we would not fault the authorities for that at all, but the reality is that's likely to result in a somewhat weaker growth environment than the country has been accustomed to.
Well, thank you so much, Razia, for giving us your take there. Razia Khan joining us from London. She's the head of regional research at Standard Chartered. And I was also joined today in the studio by Damilola Akinbami. She's an economist with financial derivatives.